Most people think a Roth IRA is simple. You put money in, it grows tax-free, and eventually you take it out tax-free. But the Roth IRA is one of the most misunderstood accounts in retirement planning. And unfortunately, misunderstandings lead to mistakes. Mistakes that may quietly cost you tens of thousands of dollars over your lifetime, especially if you're between 50 and 70 and entering the critical retirement planning window. A Roth IRA isn't just a savings bucket, it's a tax planning tool. And when it's used intentionally, the Roth IRA gives you something incredibly valuable in retirement: control. Control over your taxes, control over your income, and control over how much flexibility you have when markets, taxes, or life itself throws you something unexpected. I meet people all the time who saved incredibly well. They put decades into building a strong financial foundation, but because no one explained the Roth rules in a way that was easy to understand, they make assumptions. Small assumptions that lead to big problems later. They convert too much or not enough. They misunderstand the 5-year rules. They take withdrawals in the wrong order, or they avoid the Roth altogether because they think they're too late. Today, I want to break this down clearly, simply, and calmly so you can avoid these pitfalls I see most often and make decisions that support your long-term goals. Hi, I'm Hank Persia, President and owner of Starboard Wealth Advisors. Today, we're walking through the 5 Roth IRA mistakes that can potentially cost you thousands, sometimes without you even realizing it. Let's get into it. Mistake number 1, thinking you cannot use a Roth IRA because you make too much money. This is one of the most common misconceptions I hear. I'd love to put money into a Roth IRA, but I make too much. It's true. There are income limits for contributing directly to a Roth IRA, but those limits do not mean the Roth strategy is not available to you. Depending on your situation, you may be able to use a backdoor Roth contribution, contribute to a Roth 401k through your employer, where there's no income limits at all, or convert pre-tax money in an IRA or 401k into a Roth over time. Many high-income earners assume the IRS has completely blocked them from Roth advantages, but in reality, the IRS only restricts direct contributions, not conversions or employer Roth plans. For many people in their 50s or 60s, Roth conversions are done gradually and strategically are far more valuable than contributions anyway, because you can add more money annually. The key is understanding your tax bracket, future required withdrawals, and long-term income needs. Assuming you're not eligible often shuts the door to one of the most flexible tax strategies available. Mistake number 2, only contributing but never converting. The IRS annual allowable Roth contribution limit might allow you to add a few $1,000s a year to your account. $8,000 max in 2025 or $8,600 in 2026 based upon income. However, Roth conversions may allow you to move tens or hundreds of thousands depending upon your tax bracket and timing. Think of a Roth conversion as a mega backdoor Roth. This is where people often misunderstand the power of the Roth. For many households, their largest retirement asset is their traditional 401k or IRA, fully taxable when withdrawn. The IRS contributions to a Roth IRA might help limit the IRS required minimum distributions, RMDs, later, but they usually don't change the overall tax picture due to their small contribution size. Roth conversions, however, can have a meaningful impact on your future IRS required minimum distributions, Medicare premiums, Social Security taxation, and your lifetime tax bill. The best opportunity for conversions often appears in the years after you retire, but before RMDs start, while your taxable income is temporarily low. This period, often a decade or more, represents one of the greatest planning windows in retirement. Yet many people don't take advantage of it because they've only been told to max out 401k contributions, but never to consider a broader tax planning strategy. The goal is not to convert everything. It's to convert the right amount at the right time based upon your long-term plan. Mistake number 3, misunderstanding the 2 5-year rules. This is where Roth rules get confusing and where people accidentally step into costly mistakes. There isn't just one 5-year rule, there are two, both starting on January 1st, and they serve very different purposes. The contribution 5-year rule determines when your earnings or growth can be withdrawn tax-free, typically for one of the qualified reasons after your account has been open for 5 years. The conversion 5-year rule determines when converted principal can be withdrawn without penalty if you're younger than 59 and a half. Again, for a qualified reason after the converted funds have been in place for 5 years. These clocks operate independently, and here's the most important piece. Once you open your first Roth IRA, your contribution 5-year clock starts. Even if you open a new Roth IRA later, the original clock still applies. That's why for many people, opening a Roth IRA early, even with a small amount, can be a smart long-term move. The clock starts running long before you need it. But if you don't understand which clock applies to which type of withdrawal, you may take money out incorrectly and face taxes or penalties you didn't expect. Remember, you can always withdraw your Roth principal without penalty, since you already paid tax on that amount, since it was an after-tax contribution. It's the earnings or growth that can potentially be subject to tax and a 10% withdrawal penalty. Mistake number 4, taking Roth withdrawals too early in retirement. When someone retires, especially in their early or mid-60s, it can feel appealing to use the Roth IRA first because it's tax-free. But here's the issue. Every dollar of Roth money you use early is a dollar of tax-free leverage you lose later. And later is often when flexibility matters the most. Think about the years ahead. IRS required minimum distributions will start, Social Security can become taxable, Medicare surcharges may increase. One spouse may pass away, pushing the survivor into a higher tax bracket, and large healthcare or long-term care costs may emerge. Your Roth IRA can act as a tax-free buffer during these high-expense years. Pulling money from your Roth too early may take away options you wish you had. This doesn't mean you should never touch your Roth. It means withdrawals should be intentional based upon how they fit into a broader distribution plan that accounts for taxes, healthcare, longevity, and income needs, not just what feels easiest today. Mistake number 5, planning only for this year's taxes, not your lifetime tax bill. This is the mistake that affects most people because it's only natural to think about taxes 1 year at a time. But retirement doesn't happen on a 1-year timeline. It happens over decades, and your tax bracket won't stay the same throughout your retirement. You may experience high income years while working, low income years right after retirement, then higher income years when RMDs begin, higher income years if one spouse passes away, and fluctuating income from investments, real estate, or business interests. Roth planning is a multi-decade strategy. It's not about minimizing your tax bill in 2025 or 2026. It's about minimizing your tax bill from ages 60 through age 90. A well-designed Roth strategy can give you choices years or even decades from now when tax rates, income needs, and healthcare costs might look very different. This is where thoughtful planning pays off the most, not in the first year, but over the long run. So let's recap the 5 Roth IRA mistakes that may quietly cost you thousands over your retirement. Assuming you can't use a Roth because you earn too much, only contributing but never converting, misunderstanding the 2 5-year rules, taking Roth withdrawals too early, and planning for this year's taxes instead of your lifetime taxes. If you understand and avoid these mistakes, your Roth IRA may become one of the most powerful tools you have for building tax-efficient retirement income. Thanks for watching, and remember, good retirement planning isn't about avoiding taxes today. It's about creating the flexibility to manage taxes over decades. If you're approaching retirement and want to understand how Roth strategies could fit into your broader tax and income plan, then book a complimentary time with me using the link below. I'd be happy to take the time to walk you through your options and help you think through what may make the most sense for your family situation. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no fluff retirement guidance, or contact us for a simple phone or Zoom call. We look forward to seeing you on our next video or talking with you soon.